Hey everyone, welcome back to Corporate Decoder, the place where we decode the secrets of corporate finance, and in this filing it seems like Hilltop Holdings Inc. is singing a rather familiar tune about interest rates and banking performance. Well, almost too familiar. Let's see if there is anything new hidden in the verses right now. Hilltop Holdings Inc. is showing us its financial report card for the quarter ending the 30th of September 2025. And guess what? It is a fairly complex picture painted with a lot of numbers, but we are here to simplify it and find the story hidden within before we dive deep. If you want more of these easy to understand breakdowns of financial reports, make sure you hit that subscribe button and enable notifications. Also, a big shout out to our awesome Discord community linked in the description, where we discuss all things corporate finance and investing. This is your chance to connect with like-minded people and get exclusive insights. Let's get right into it. Our focus today is on the financial statements, the concrete numbers that tell us where Hilltop stands and where it might be going. Alright, first up we are looking at the consolidated balance sheets. This is like a snapshot of everything the company owns and owes on the 30th of September 2025. On this date, their total assets were around $15.6 billion. This might sound like a lot, but it is actually down from over $16.2 billion at the end of 2024. That's a drop of about $600 million, or a little over 3%. While they have a lot of assets, the total amount is shrinking. This could mean they are selling things off or not acquiring as much compared to before. Now let's look at cash, and due from banks they had about $1.27 billion in cash on hand at the end of September 2025, which is a pretty big decrease from almost $2.3 billion at the end of 2024. That is almost $1 billion drop in cash, or about 44%. This is a pretty significant chunk of cash gone where, well, their balance sheet shows they used a lot of cash to pay down debt and buy back their own stock, which are pretty common things to do with excess cash, but still a big drop in readily available cash. Okay, moving down to their loans held for investment account. This is where they keep the loans they plan to hold for a while, not to sell right away on the 30th of September 2025. This number was about $8.1 billion, which is up from about $7.8 billion at the end of 24. This is a small increase of about 3.6%. While this number is growing, it is good to see their allowance for credit losses, which helps cover potential loan defaults, has also decreased from about $101 million to $95 million. This could mean they are feeling more confident about their borrowers' ability to repay, or maybe they have tightened up their lending standards. Now let's talk about liabilities, and specifically broker, dealer, and clearing organization payables, which at the 30th of September 2025 were about $1.44 billion. This is up from about $1.33 billion at the end of 2024. This increase means the broker-dealer side owes more money to others. This segment of the business seems to be growing. Overall total liabilities stood at about $13.38 billion at the end of September 2025. This is a decrease from about $14.05 billion at the end of 2024. So over the last year, they have reduced their total debt, which is generally a good sign for financial health. Swinging over to the equity side of the balance sheet, we see their common stock, their issued and outstanding shares, dropped from about 65 million at the end of 2024 to just under 61.4 million at the end of September 2025. This is a decrease of about 3.6 million shares, or nearly 6%. This big of a drop usually indicates significant stock buybacks, which we will talk more about later. Now let's look at the consolidated statements of operations. This is where we see how much money they made and spent over a period. Let's focus on the 3 months ended the 30th of September 2025 compared to the same period in 2024. Their net interest income for the 3 months ending the 30th of September 2025 was about $112 million. This is up from about $105 million in the same period of 2024. That's a nice increase of about 7%. This is good news, as net interest income is usually the bread and butter for banks, meaning they are earning more from their lending and investment activities than they are paying out on deposits. Then we have total non-interest income. This includes things like fees for services and gains from trading activities for the 3 months ending the 30th of September 2025. It was about $217.8 million, which is up from about $200.4 million in 2024. A good jump of about 8.6%. This growth in non-interest income is a positive sign, as it shows the company is diversifying its revenue streams beyond just interest. But then we look at total non-interest expense, which was about $271.9 million for the 3 months, ending the 30th of September 2025. This is a slight increase from about $264.3 million in 2024. This means their costs went up a bit as well. Putting it all together, their income before income taxes was about $60.8 million for the 3 months ending the 30th of September 2025. This is up from about $42.4 million in 2024. They are making more money. And for the shareholders, the income attributable to Hilltop was about $45.8 million for the 3 months ending the 30th of September 2025, compared to $29.7 million in 2024. That's a solid increase of over 50%. And their earnings per common share, this is what matters to us as investors for the 3 months ending the 30th of September 2025 basic earnings. Per S-Hair was $0.74, up from $0.46 a year ago. Diluted earnings were also $0.74, up from $0.46. This shows a good improvement in profitability on a per share basis. Now let's look at the 9 months ended the 30th of September 2025 compared to the same 9 months in 2024. For the 9-month period, income attributable to Hilltop was $124 million. This is a big jump from about $77.7 million in the same period of 2024. That's a significant increase of nearly 60%. And diluted earnings per share were $1.95, up from $1.19 a year ago. This means the company is becoming more profitable on a per share basis year over year. Now let's drill down into some of the specific details that often hide the real story behind the numbers. Here we see mortgage servicing rights, or MSR, which are basically the right to collect mortgage payments for a fee. This asset is valued at about $12.3 million at the end of September 2025. This value has fluctuated a lot but looks to be stable for now. When they talk about fair value inputs level 3, a good chunk of their assets are valued using unobservable inputs, meaning their own estimates. This is where things can get a bit subjective. They are required to disclose how they value things, and there is a hierarchy. Level 1 is the most reliable based on quoted prices in active markets. Level 2 uses observable market data, and Level 3 relies on their own internal models and estimates. Their loans held for sale had a fair value adjustment of about $17 million to the unpaid principal balance of $774.8 million, meaning the market values these loans a bit lower than their face value. That brings the total to about $791.8 million. Now this is interesting. The company spent about $123.2 million to repurchase nearly 4 million shares of its own stock during the 9 months ended the 30th of September 2025. This is why their share count dropped so much. This is a common strategy to return value to shareholders and boost earnings per S-Hair, but it does reduce the cash available. They are involved in various legal and regulatory matters, but management believes these will not have a material impact on the company, except for a specific inquiry from the United States Attorney regarding Primalending's float-down option. This is something to keep an eye on. Looking at their loan portfolio, management is tracking potential problem loans, which decreased significantly from about $166.9 million at the end of 2024 to about $119.3 million at the end of September 2025. This is a positive trend indicating improved credit quality in their loan book. And on the flip side, non-accrual loans, meaning loans that are not currently earning interest, also decreased. This is generally a good sign for the bank's health. So what does this all mean for Hilltop Holdings Inc.? They are showing solid growth in their core banking business with net interest income, and overall profitability up. The mortgage segment is still facing challenges evident in its operating losses, but cost-cutting measures are in place. The broker dealer segment is performing well with improved revenues. However, the shrinking cash balance due to debt repayment and stock buybacks is something to monitor. While these are often good strategic moves, it does reduce their immediate financial flexibility. Risks are always present, especially in the financial sector. The report mentions interest rate sensitivity and potential impacts from economic downturns and regulatory changes. The merchant bank transaction did provide a nice boost to earnings this quarter, but its future impact and the successful liquidation of those assets will be key. Overall, Hilltop Holdings Inc. seems to be navigating a complex economic environment fairly well. Their banking segment is strong and showing good profitability. The mortgage segment is a drag, but they are taking steps to manage it, and the stock buybacks are boosting shareholder value. What is your take on these numbers? Do you think Hilltop's strategy is sound, or are there red flags we should be more concerned about? Let me know your thoughts in the comments below. If you found this breakdown helpful, please hit that like button and subscribe for more corporate decoding adventures. And remember to check out the Discord channel linked in the description to join our growing community. Thanks for watching, and we will see you in the next video.